I'm going to show you guys the stock that gained over 600% in 1 year and an ETF that gained over 200% in a year. But before I can do this, you guys have to understand the basic terms and what an ETF and stock even means. So stick around and let's get to it. What's going on, boys and girls? Thanks for coming back, and if you're new to the channel, I'm Guy Graywell, and I'm not a financial advisor, so everything I say here is for entertainment purposes only, and these are only my opinions. So before we get started, I want to let you guys know that I'm going to be making another video very soon that explains what type of platforms you guys want to download or what kind of accounts you guys want to use to be investing in all these stocks or ETFs. But the reason why you guys need to understand if you guys want to go the stock investing route or the ETF or either is because all these platforms have different features that you guys might like better. So the first thing you guys need to know is what is a stock and what is a share. So essentially it's the same thing. The stock is what is being traded on the exchanges and shares are what you own. So when you purchase a company's stock, you're purchasing a small piece of that company called a share. So I can have 10 shares of Tesla. That just means that I own Tesla stock. So it is the same thing, and corporations issue their stock to the public to raise money. So there's two ways of raising money. Either you go to the bank, you get a loan, they tell you that you have to pay it back within a number of years and they tell you the interest rate, or you can go to the markets, the exchanges, give away a piece of your company. So it's up to you how much you want to give away. If a company is worth $10 million and you need $5 million to open up a factory, you're going to have to give away 50% of your company, which, say for example, if you own 10 shares, you'll have to give away 5 shares. But it is a lot cheaper because you don't have to actually pay it back. But there are a lot of drawbacks. So if someone else owns 5 shares and there's only 10 shares in that entire company, they do essentially get 50% of the profits. That doesn't mean that the company will always give you the profits. It just means that if they are making money and they do decide to give you the profits, which are called dividends, you would actually get 50% of the profits. But a lot of these companies that are growing at a quick rate, they'll reinvest that money to help them grow even quicker. And they usually won't pay any dividends until way later, until they really don't know what to do with their money. But there are a lot of other companies that, for example, give a very, very good dividend every month. So that's really up to you guys on which companies you guys want to purchase. But there are a lot of reasons why companies will issue shares. So I'm going to give you guys a basic example of stocks. So pretend like I started a company called Amazing Shaker Cups, and then there's Bob's Water Bottles. So my shares trade at $50 on the market, but there's only 2 shares available. So that means the company value is $100. Whereas Bob's Water Bottle Company, his shares are only $1, but he has 100 shares traded on the market. So his company value is still $100, even though my share is 50 times the price of his share. So please guys, do not look at the share price when you guys are purchasing all these stocks. Look at the value of the actual company. The share price doesn't matter as much because companies can split their shares anytime they want. So if I want my share to be trading at 25, I'll just do a split and then there'll be 4 shares traded on the market. So that doesn't really matter. Also, not all the companies that you guys may want to purchase are traded on the market, because say for example that my company, my Amazing Shaker Cups, I want to give away 50% of my company. Would I rather give it away to a stranger that I don't know, or would I rather give it away to like Allmax here and tell them to sell my shaker cups to all their customers? So it's definitely a little bit more valuable picking your investors. So companies will sometimes go to like angel investors or venture capitalists, which are just fancy names for saying people that are willing to give them money and they kind of help them with their company. So some companies that don't really have any issue with raising capital, they would rather not go on the public exchanges. But for companies that do need capital, they can go to these public exchanges, they can sell their shares to the public through what's called an IPO or initial public offering. So this is just one example of a stock that I wanted to show you guys. This one went up 675%. So it was trading at roughly like the $4 or $5 mark for quite some time, about over 6 months, and then all of a sudden from September it blew up. But this is how stocks usually react, because it's just one company. So for example, if that company tells the public that they created a new product that no one has on the market, that stock will shoot through the roof, most likely if it is a good product. And also looking at other factors, like if they can actually follow through with creating the product. But I just want to let you guys know that stocks are a lot more risky and they're a lot more volatile. So now let's go look at some ETFs, which are a little bit safer. So an ETF is an exchange traded fund. So this is a type of security that involves a collection of securities. So it's pretty much buying and selling a basket of assets. So if I want to buy Facebook, Google, Microsoft, Apple, Tesla, I would have to buy every single stock individually. Or I can buy an ETF, which is still a stock on the market, but that one stock, imagine it as a company that owns a portion of all those other companies. So it is a little bit better in terms of it has a little bit less risk, and it's a lot more diversified. And it's a lot easier to diversify through an ETF than rather buying individual stocks, because it does get very expensive. So there are tons of ETFs for every almost category that you guys can think of. There's stock ETFs, there's commodity ETFs that purchase like gold, silver, oil. There's sector ETFs that focus on only healthcare or financial or only like the industrial sector. And usually in an ETF, if you just Google that ETF name, you can actually see all their holdings and go through each in every stock and see how much of that ETF is made up of that one stock. But I'll give you guys an example of this a little bit later in the video. So this is one of the ETFs that I want you guys to know about. I'll let you guys know what this is called later in the video. But ETFs, just because they're less risk and way more diversified, doesn't mean that you guys can't make a lot of money off of these. This one ETF went up 200% in 1 year. The average stock goes up like 10%. There's a lot of return to be made. You guys just have to look through which ones and which sectors and what industry you guys want to purchase. So the next thing we're going to answer is, where are they traded and how do they move? So in a very basic definition, again, it's just supply and demand. If a lot of people are demanding the Tesla stock and there's not a lot of supply, the price will continue to go up. But if a lot of people want to get rid of it, the supply increases but not a lot of people want it, the price will go down, because people will be willing to sell their share for a little bit less because it's not getting bought as quickly. So think of like a very big Facebook marketplace, but only for stocks. For example, if there's 5 people selling like a PS5, but there's 10 people that are wanting to buy it, all those buyers may be willing to pay a little bit extra because there's only 5 that are available. But if we switch that around and there's 10 people that are selling it, but only 5 people buying it, one person may want the money really quickly. He may have an emergency. There may be something like an event that he didn't know about. So he might be willing to sell his PlayStation for $200 less. So as that happens, the price will continue to fall. But there are a lot of other factors that affect that. For example, if the demand goes up but the supply also goes up, then the price stays consistent. The overall market is made up of millions and millions of investors, and when you're buying something, you're not actually buying it from that company itself. You're just buying it from another person that's selling it to you. And the same thing when you're selling this stock. When you're selling it, you're just selling it to another person that's on the exchange that is wanting to buy that share. And the stock market or the stock exchange is just a platform where you guys can trade this easily. So the biggest platforms in the world are the New York Stock Exchange and the NASDAQ. But countries have their little exchanges themselves as well. Like we have our Toronto Stock Exchange, like China, Shanghai, they all have their own. There's Japan, there's London, Hong Kong, but these aren't as popular. So a lot of people want to get on the New York Stock Exchange and the NASDAQ, because the more people that are on those exchanges, the more people that are willing to buy that stock. And then slowly the price of that stock will go up, and the more money that they can actually raise. So now that you guys have a basic understanding of what a stock is and where we can purchase them, let's dive right in and figure out if you guys want to be self-directed and active investors or passive investors. So if you're an active investor, this requires a lot more homework, and you have to really dive deep and do the analysis for those companies, because when you're purchasing a stock, it's just one company. If that company does bad, you're going to lose all your money. So there is a high risk and high reward potential, because if that one company does really well, like I showed you guys before, that one stock went up 675%. Imagine putting $1,000 in there and then next year you pulling out 6,000, or imagine putting 10,000, pulling out 60 or 70,000. And also there is a lot more flexibility because you can sell that stock anytime you want, and it's really just that one company you have to focus on. And this requires a lot more time because you guys have to, even if you buy a stock, you can't just leave it there unless you're very satisfied with the management team and you believe in them with your eyes closed, and you're willing to hold on to the investment for 10, 15, 20 years and beyond. But if you guys aren't that sure, you're going to have to keep up with all the information that they're releasing, what they're doing in the future, if they need more money, things are doing good, things are doing bad. Whereas if you guys are passive investors and you guys want to purchase like ETFs or something, it's a lot easier to just throw your money in an ETF because it is a lot more diversified. So if that one stock goes down, you don't have to worry because usually ETFs won't have larger than a 10% position in a single stock. Usually it's like 5-6% for the biggest holdings, and then they have hundreds of other holdings that are barely 1% of that ETF. So if you guys don't have too much experience, you guys can go the passive route. And I'm not saying if you guys are an experienced investor, you guys shouldn't take this route, but it's a lot easier to be a passive investor because it doesn't require as much analysis as you would need for stocks, because there is a greater risk in that. So it really depends on what your strategy is and what your goal is. With passive investing, you want to just buy and hold. This can be done through ETFs or even stocks. For example, if you buy the RBC stock, it does pay a dividend of 4% a year. So every single year, you'll receive 4% of your initial investment. So if you put in $10,000, you'll get $400 in dividends, but that stock might actually go up as well. So you'll be getting dividends, and the value of your shares will also be increasing over time. So finally, getting onto that ETF that went up 200%. And guys, if you made it to this part of the video, thank you. And if you guys like what you guys are seeing, please hit the like and subscribe button below. So Cathie Wood is one of the best investors, and she tries to find the next big thing, and she's very forward looking into the future. So one of the ETFs that she created is ARC Genomic Revolution. And if you just Google ARC Genomic Revolution ETF, you can see all the holdings in that ETF. And the biggest holding in that ETF is Pacific Biosciences. And we can see here that she owns $630 million of that stock, and it's about 6.5% of that entire ETF. So here I have a side-by-side image of Pacific Biosciences stock and ARC Genomic Revolution ETF. If you guys look at the red highlighted areas of Pacific Biosciences, you can see that all the way from March up until about September, it was trading below $10. And then in those 3-4 months, it went from $10 to over $30, which is a 300% return. But if you look at the ETF, it's been consistently going up because it's made up of so many different stocks. With an ETF, you may get some consistent returns, but they may be slower over time. So depending on your risk level, you guys can choose between either a stock or a separate ETF. Thanks for watching, guys. If you liked the video, please hit like and subscribe, and I'll keep the content coming.